Good morning, everyone. A very warm welcome to the offices of Bird & Bird in central London. I'm Karen Freeb. I head up Bird & Bird's international hospitality and hotels team. And the welcome is to the latest in the series of webinars that we have been running, co-hosting since lockdown with HVS, AlixPartners and EP Business in Hospitality. But the most exciting thing about today's session is that we have a number of people in the room with us in person. This is the first in-person conference that we've hosted since pre-lockdown. So that's great. So great to see so many people in the room today, and also a very warm welcome to those of you who've dialed in on Zoom. We're going to be starting off very shortly with the main panel session, and we will wrap up by 11 a.m. So we're hoping for a very lively session today with lots of interesting information for you to take away. That leaves me only to introduce you to Chris Shepherdson, who is the founder of EP Business in Hospitality, who will introduce our speakers and panelists today. And I'd say that all of our speakers and panelists are here in the room with us. Thank you.
Thank you, Karen. Thank you for hosting today. It's great to be back and doing live events, isn't it? I think, rather than just doing the kind of Zoom. Lovely to see you all. Thank you for coming along today. I'll be brief, but I always like to just try and make a few comments as we go. I think this is an incredibly important topic to discuss. Everywhere we seem to be going at the moment, we seem to be having conversations that ask more questions than have answers. And I think what's going to be really interesting today is seeing some of those questions answered in a number of ways. I find when we're talking to boards, there are three questions that seem to be the main three planks of discussion. One, have we done enough? Are we well enough prepared for coming out of this pandemic? Have we done enough to prepare the ground for that? What's actually changed? And that's a really interesting question. And the third one is, our balance sheet good enough and able enough to get through this period of time? And everyone has so many different views and discussions on that. And that's why I'm really interested to see the views that come out today. But these are questions not just being posed by boards, they're being posed by returning employees and by investors. So it is obviously going to need, I think, particularly the next 6 months, probably the core discussion that we're going to be seeing. And look, I think we all know that the next 6 months is going to be challenging in a whole range of ways. So again, this discussion couldn't come at probably at a more apt time. So again, I'm looking very much forward to what everyone's got to say. We have excellent speakers today and an excellent panel for you to listen to. And the kind of questions they're going to be answering: what are the most pressing issues affecting the hotel sector at this moment in time? What are the major concerns that are really flashing the red lights that people are thinking about? Is there funding to be accessed? And what is the view of the sector and the immediate future? These are just broad ones, but they're going to be answered as we go along this afternoon. Before I introduce you to Graham and James, and then obviously on to Russell and the panel, let's just give a little bit of background by some of the issues that people are discussing at this moment in time. Firstly, I mean, Brexit, that B word seems to be back in discussion again, which seems to be coming up. Everyone seems to be blaming Brexit for this and that, and I'm sure there's all kinds of influences that are in play. However, a lot of the issues we're talking about are actually global. We've seen the same trends in Europe, we've seen the same trends in the US. So what is it that's actually creating these influences all across the world and all across the developed countries? It isn't quite as simple as sometimes we try and make it. Companies are struggling to find staff and talent. I think everyone knows that. UK hospitality estimate there's going to be 188,000 vacancies at any one time over the next 18 months. That's a huge amount of vacancies. So what are we going to do about that? And to make it harder, average salaries for lower paid staff are going to increase by 25 to 30%. That's a huge increase. And then what ramifications are that going to be? And is that going to be wage inflation all over the place? At the same time, we've got food inflation that's going to average by the end of this year between 6 to 7%, which will see bills obviously escalating and costs escalating everywhere. Forecast for those professionals returning to London, and I'm sure we're all watching the tubes and the trains quite closely, is 45% by the year end, rising between 60 to 70% in 2022. Now, those figures are still estimates. We're all learning as we go along, aren't we? But whichever way you like to look at it, if those figures are close to accurate, we're still looking at a 30% less density in London than professional workers on over a week's basis. What are the ramifications of that? How's that impact on the high street? How's it impact on restaurants and hotels? Business travel is still not expected to return strength to 2025, and that actually has a huge spend as well in hotels. What does that actually all mean, and how is that actually going to play out? Are we going to see more hotels coming online when there seems to be less and less business? So it's an interesting one to watch, isn't it? Most companies seem to be expecting back to 75% revenues in 2022, and back of 2022 against 2019 figures, and yet we're only going to have about 60% of people in London. So how's all this work, and what are the actual likelihood of these forecasts? And again, are we in a good enough place to have actually weathered this period of time and come out the other end? It's going to be interesting. Is the balance sheet strong enough, which James and Graham and the panel will talk about, and what's actually changed, and what do we need to change going forward? It's going to be a deeply challenging period. We know that. That's what makes this so good. There are going to be winners and losers. It's going to take a lot of courage and bravery to get through this period of time. But there's also going to be new solutions and thinking that comes out. And it's those new solutions of thinking that actually make these sessions so important as we share knowledge. So look, welcome today. I'm really looking forward to this. Let me first have the pleasure of introducing Graham Smith, Managing Director of AlixPartners, up to the podium to talk and start this discussion on these issues. And I look forward to coming back and asking questions later. Thank you, Graham.
Thanks, Chris, and welcome to everybody in the room and also on the call. So I'm Graham Smith. I head up the hospitality and leisure practice at AlixPartners. I specialise on transactions, financing and restructuring across the hotel market. So I'm going to speak to you all about four things today. First of all, answering the question I probably get asked most, which is, why haven't we seen a wave of restructuring activity in the sector given all the challenges? Secondly, what might change to change that position? Third, around some of the challenges around looking forward to the future and how to feed those into your planning. And finally, some of the key steps I think people need to be looking at in order to make sure they've got the resilience in their balance sheet to be able to survive the current challenges, escape the other side, and really thrive through the recovery. So first of all, in terms of why haven't we seen a real wave of distress and restructuring given all of the challenges that the sector has faced? Well, looking at this compared to where we were in the great financial crisis, there are a number of differences which I think create the position we have today. First of all, around the lender landscape, we have a much more diversified lender landscape in the market today than we did at the great financial crisis. That diversification with different institution types means that actually the ability to absorb shocks in the system is much greater. In terms of the leverage levels, actually, we entered the COVID crisis with lower loan-to-value levels. And actually, through the crisis itself, with the compression in yields, valuations have held up remarkably well. So it hasn't created that real downward pressure on valuations and LTVs. Also, when we think about the expected shape of the recovery, this is seen very much as a supply side issue. This is not a weakness and a lack of demand that's going to take years and years to recover. This is much more around a supply side issue, more akin to a natural disaster almost, where the demand is there, it just needs to be reopened so that the market can accept it. And that reopening was expected to follow with the rollout of the vaccine. With regard to the capital structures, whilst LTVs were lower, we did see an increase in complexity, return of sale and leasebacks, ground rent deals, REITs remaining in the market. But then as we went through the crisis, then the layering in of additional debt through government schemes such as CL bills. And that complexity just means that actually restructuring processes are a little bit more challenging to go through. So you really only want to go through it when you absolutely have to. And the final point is around the funding options. I think we're all aware of the level of equity, certainly that's available in the market. And also the government support that's been injected, all there to provide liquidity in order to survive and also support the P&Ls as the businesses recover. So what has that meant? Well, it's been really, we've had this market consensus that actually holding on, just waiting, is the right thing to do. Provide the support so that businesses can escape on the other side and just wait for the market to recover. A real kind of standstill, if you like, from the financial stakeholders. So what might cause that to change? What might be different now that we're entering, if you like, the recovery phase in the market? It might result in this consensus around standstill falling away. Well, first of all, I think the main point for me actually is outlook. I think if we sat in the winter of 2020, it was quite easy to look around and think, well, tomorrow will definitely be better than today. So why would I take any action today that might crystallize a position? Actually, now as we sit in the market, we can see that things are being reopened, the demand is coming back in, and we're in a more nuanced situation. Will 12 months' time be better than today? Maybe, but it might not be. So actually, people have to take a decision based on the facts at hand rather than a broad consensus that tomorrow will definitely be better. One of the aspects that feeds into that is around government support. We see this is starting to get reined back, whether it's furlough, whether it's VAT levels, rates relief, protection from action from landlords. That's all starting to be wound back, and it will start to create some cash flow pressures that perhaps weren't there previously. And I'll pick up on this next point just after this slide around the multi-speed recovery. Whilst everything is closed, then everything is behaving exactly the same. As things start to reopen, then fine, things all start to reopen at similar speed. But actually, as we now get back into more fuller recovery, there's definitely different speeds of recovery depending on the hotel type that you're facing. Bank attitudes, then I think there's been actually broad consensus that banks have been almost universally supportive and lenders have been universally supportive of assets in the sector. But I think now as we start to get into the recovery phase, there is the chance that some institutions will look at it and take the view that actually, they're overexposed to the sector. They do want to rein things back a little and may be looking at opportunities to try and trigger refinancings and repayments. But finally, the investor appetite remains. And whilst this is a good thing, it gives confidence to the sector, it does play into some of the potential lender behaviours as we get into this recovery phase. And what does all of this mean? Well, in my view, we're entering a period where lender decision making is going to be very much in situation specific now. People are going to be looking at the facts at hand with the business that's being considered. And that plan to deleverage, we've all been covenant holidays, which is quite right. It's given accommodation space for businesses to recover. But as those holidays start to fall away, then businesses are going to have to come forward, hoteliers are going to have to come forward with a plan in order to bring those leverage levels back within the levels that a lender is comfortable with. And that plan must be clear in order to maintain that lender support. And this final point around that investor appetite and the confidence in the value recovery, actually, this is one of the points that may cause certain institutions, if they need to step back from the sector, actually just to try and trigger some of those positions because they've got a confidence that they will be repaid, they will make a recovery. So this, in conclusion on this slide, then do keep an eye on those leverage covenants. We haven't had to worry about them for a little while now, but they will be coming back in. And we need to look forward at those forecasts to make sure that we're able to stay compliant. And actually, it's this thing which may trigger refinancings, it may trigger restructurings, possibly disposals as part of the way that lenders get repaid in the event that they don't want to retain that exposure to that asset. But that all depends on looking at the future. And as we've seen, when we talk about the multi-speed recovery, probably the future's never been harder to predict. We've got a slide here that shows just the scale at which we have a multi-speed recovery. So the chart here shows RevPAR levels across different hotel types: coastal, leisure-focused, corporate, airport, and London, and shows their RevPAR levels indexed back to the equivalent period in 2019, and the red line being, if you like, par at 100% of where the business was in 2019. So back in Q2 2020, we can see most hotels closed, all suffering almost equally. But actually then, as you cast the time forward and come to July 21, then that's when you start to see this huge disparity in performance and recovery rate, with the coastal properties trade indexing at 125 points of where they were in 2019, and London really struggling there at 33% of where they were in 2019. I think you could talk to anybody pre-pandemic to say that you'd rather have a hotel in Bournemouth than Belgravia. People would have looked at you as though you were mad. But that's absolutely what happened in July 21. So this volatility in recovery really makes that forecasting incredibly challenging. And this is going to be key in terms of, as we think about how do you make sure you've got a balance sheet resilient enough for the recovery, you're going to have to look at scenario analysis to deal with this, because the future is so unclear. And how might that play through? Well, that shape of recovery is going to lead to different strategies depending on the deleveraging plan. I'm just taking a chart here, looking at the two extremes of that previous chart. At one level, the light blue line being coastal properties, and the dark grey line at the bottom being London properties. So the coastal properties obviously enjoyed an incredibly strong summer during 2021. And these are not forecasts. This is not what we think will absolutely happen, but it could be indicative of what would happen. And this is, again, looking at the RevPAR performance relative to a 2019 index. So a reasonable scenario to consider might well be that July 2021 for coastal properties incredibly strong. But what happens if actually the overseas travel becomes much easier during the summer of 22? Do all those people who rush to UK staycation locations actually then jump on flights to get out of the country because they're desperate to go and visit overseas properties and overseas countries? Maybe. So we might see a reversal actually of that overperformance. And what's important with that is that it's around, as you look at your deleveraging plan, just extrapolating out what's happened in recent times isn't going to be the most sustainable way to look at your balance sheet. You've got to factor in these potential scenarios to make sure you've got the headroom. Likewise, on London, that may well be a slower, more steady recovery, actually, as demand starts to flow steadily into the system and corporate international travel and MICE demand is slower to recover. And in this situation, cash flows may remain under pressure for a little longer. So really, as a borrower and with the lender and shareholder, the look-through has to be to the underpinning asset value of that property. You know, nobody is saying that in long term people don't want to own London hotel assets, but it may have some greater cash flow pressures in the short term. So just that emphasis of focus to ensure resilience. But in both situations, what we need to look at is a potential pinch point we look forward to next summer. And this is around the cost inflation that's coming through everybody's systems at the moment. Very hard for revenue to keep pace with this. So again, as people look at their cash flow forecast, look at their forecast through 2022, you know, if the summer doesn't perform as it did this year, if rates aren't able to keep pace with that inflation, there is the potential for some cash flow pinches to be felt through the middle of next year. So again, just something to be aware of as businesses look at plans. So what does all this mean in terms of what should hoteliers, borrowers be doing to make sure that they've got the resilience to survive through to a full recovery? First of all, you need to get under the skin and understand the covenant headroom that you've got in different scenarios, not just on liquidity, but also on leverage. But be realistic about that outlook. Okay, yes, it may well have been a good summer, but what if next summer's tougher? Okay, include the cost pressures coming in. Then under those scenarios, how much headroom have you got, and make plans to match that? If the headroom does look tight and you can see that coming, that's what gives you the chance early on to look at the options to deal with that. Do you need to have further conversations with your lenders, with your shareholders, get further funding or further accommodation? Or do you need to contemplate going outside and looking for external funding to meet those pinch points? And finally, the main point through all of this, of course, is just actively engage with those stakeholders, with your shareholders, with your lenders. Everybody accepts that this crisis wasn't of anybody's making, but really it comes down to how are people dealing with that? What are the actions that they're taking? Are they communicating and make sure that everybody's aware of where these issues are arising? And if you've got that communication, you generally tend to get the support. So in conclusion, we may well be in for a bit of a bumpy ride. And I think we should very much be alive to the fact that there may well be further action that needs to be taken with the funding position, with the balance sheet, to make sure that the businesses have got the resilience to survive through to a full recovery. Thank you.
Well, thank you, Graham, and good morning, everyone. For those who don't know me, I'm James Salford. I'm a partner here at Bird & Bird in the hotels team. So we're going to move on from what Graham's talking about and sort of really reflect on the lending landscape and what I think is going to happen over the next 12, 18 months, to the extent it's possible to guess. But before we do that, let's have a quick recap of where we've got to over the last year and a half during COVID. So as Graham's touched on, the lenders have been phenomenally supportive. And I think for many in the hotel industry who don't deal with the lenders day to day, they probably don't appreciate just how hard many of the lenders have really worked to deliver to support the industry over the last 18 months. They really have done a fantastic job. And I think as an industry, we need to be very, very grateful for the incredible hard work they've put in over the last year. But they've been very supportive, helping to deal with covenant waivers, obviously backed by the government and the regulators, but many of the lenders have provided additional capital. They've done C-bills and CL bills for a lot of the hotel groups to provide them working capital through the group. So they really have been phenomenally supportive. And in many cases, we've seen financial covenants on hotels, deals waived for 18 months, even 2 years. So, I mean, it's an extraordinary, unusual situation to see that level of covenant waiver, but clearly, in extraordinary times, the lenders really have stepped up and supported the industry in a phenomenal way. And as Graham said, we've seen very, very few enforcements to date in the hotel sector. Graham's also pointed out that hotel values have held up, and there are a number of reasons for that. So despite the fact performance is clearly flatlined with no one staying in hotels, although that's not universally the case, the weight of capital coming into the sector has absolutely propped that up. And we'll come back to that, because I think that's a very, very positive note for the industry as a whole. Hotel, there is a lot of money wanting to invest in hotels, and that has to be a good thing for us as an industry. I think what is interesting is that the market outlook is very hard to call. If you'd gone back 2 years ago, and I read countless credit papers, spoke to an awful lot of lenders about what they thought would happen, which hotels would perform well in a recession, which hotels would perform badly. The reality is they all got it spectacularly wrong. Everybody thought Central London and Central Edinburgh would be bulletproof. Everyone thought country house hotels, regional hotels would struggle in a downturn. Of course, the reality, as Graham's pointed out, it's been the complete opposite. Those regional hotels have absolutely flown, and having paid £300 a night for a night in Brighton, that sort of testament to how those regional markets have frankly really stood up against, recovered from the pandemic. Conversely, Central London is struggling, will struggle. I think the biggest challenge that the lenders are going to have and investors are going to have as we go forward is sitting here today. Clearly, it was understandable that if you look at it now, that with staycations, that those hotels were going to perform incredibly well. The real challenge for lenders and investors, how is that going to come back? And I think whether you're an investor buying an asset, whether you're a lender lending on an asset, the key question is, when is London going to come back? The norms we expected pre-COVID, so regular business travel, what's going to happen to that? I mean, as a firm, we currently still can't travel. We had a session yesterday highlighting the challenges going to Europe caused by Brexit, which is just one factor that's going to make it much harder to do business travel around Europe. When are the Americans going to start coming back regularly to the UK? All of those questions, I think, will Zoom and the online web meetings change the way we do business? I think that's all incredibly hard to predict, and probably one for the panel of lenders later. But if you are a lender, how do you write your credit paper? When you take a deal, what is it you're going to say to the credit teams in terms of a new deal? How's that going to work? What is the new norm going to look like? And I think that's probably the biggest change from COVID, is that the norms that we have worked on, investors and lenders have thought about simply aren't guaranteed anymore. I think the market, the dynamic has totally changed, and it will take a while for that to bottom out, for people to understand what that new norm is going to look like. I think as we come into it as well, there are going to be some significant challenges for lending. We've already touched about the pressure on cost, the lack of employment. Having down in Cornwall a couple of weeks ago, Rick Stein's restaurant is shut because he can't get any staff to serve people. So, for hotels in London, how's that going to work if they're losing their F&B income? What impact that's going to have? And I think the great unknown, the lenders have been hugely supportive, but there is an elephant in the room there, which is the day of reckoning is now coming, in that they've supported all these hotels. One of the consequences of all this additional capital is that a lot of those hotel deals are now far more heavily geared than they were 2 years ago. How is that going to play out? Because the lenders are now having to address the fact that the capital weighting of their hotel books and their real estate books has gone up. So there are definitely some challenges for the market going forward. Having said that, I think there is a positive market, despite how challenging it's been. There are a number of banks, a number of them in this room, who are actively lending, have actually been lending throughout the pandemic. There is also the trend we've seen that came from the US 10, 15 years ago, has really sort of run through the real estate industry, but now is very much benefiting the hotel industry, is that the debt funds, the alternative lenders, are really seeing hotels as a great sector to invest in. And there is no question that even during the pandemic, the number of lenders willing to invest into this market has increased significantly. And that's a positive thing. Similarly, there is been a real growth of lenders prepared to lend at different points in the capital stack. So there's been a real growth in lenders prepared to do mezzanine finance, and we've seen far more mezz finance deals we've seen for a very long time. There's been a real growth in lenders prepared to do pref equity style lending. So the reality is, for those hotel owners who are overcapitalized, there is money out there. I think the real challenge will be for the owners to recognize that they might have to if they are overgeared, they may have to sacrifice some of their capital in order to recapitalize themselves and some of their equity in order to do that. But that's probably better than getting to where we'll end up, which is ultimately lenders having to enforce or take assets back. So I think for owners, it's about recognizing where you are in the leverage position and accepting that there is money out there to fix it. You can do a deal. There's definitely willingness on investors, lenders to do a deal, but there is going to be a price for doing that. Looking at existing deals, so what have we seen? As I said, a number of banks are back in the market, but I think a lot of the banks are simply they've managed to cope with what with the pandemic, but they've been very busy doing COVID, doing C-bills, lending additional capital. They are now sitting back and taking stock. And indeed, for a lot of those lenders, the loans that were done 3, 4, 5 years ago are coming up for refinance. And what are we seeing there? I think we're seeing the lenders looking at that, looking back to the capital weighting of their books and using this as a bit of an opportunity, or indeed a requirement, to reprice their books. So we are seeing on deals where we're coming up for refi at the moment, we're seeing pricing going up. I'm sure the lenders will give me more accurate number, but I would guess it's somewhere between, for conventional senior debt, we're seeing pricing increase by 75 to 100 basis points would be a typical increase on a standard senior debt position. Now, that obviously has an impact on cash flows for the business, and we'll come to that in a bit. Coming back, as I've said, we have seen a lot of lenders come into the sector and a lot of investors come into the sector. And one of the reasons for that is that if you look at the other real estate classes that people might want to invest in or lend to, they're actually struggling as well. So retail, clearly very unpopular right now. Logistics, we were talking a little bit earlier, been very, very popular, but it's starting to get a bit overheated. Anybody have a view on offices, where they're all going to be in big buildings like this in the future? So if you look at the other sectors that the lenders conventionally lend to, they're certainly not straightforward. And I think if you can take a positive view on where hotels are going, then I think you can see that from a lender's perspective, from an investor's perspective, it's actually quite a positive outlook. Tricky news is development finance is still incredibly hard to secure. It is out there, you can get it, but it is not easy, it is expensive. And I think that will take a while to come back. I think the lenders who do development finance, either they're charging very high pricing for doing it, or those that have conventionally done it are struggling to get it away. I see Louise here, who may well take a slightly different view, but as a general market trend, it is very difficult to get development finance off the ground. Conversely, and I think I said one of these about a year ago, I thought ground rent structures were dead. I'm completely wrong. Ground rent structures are not dead. They're widely available. You can still get money for ground rents. And I've seen a number of deals where people are putting them in. Where I think it is tricky is doing ground rent with conventional debt. But again, even there, we are seeing the odd deal. I'm not saying they're straightforward. They are very complex to do in this climate, but it is still just about possible to do a ground rent with debt. But I think what we will see going forward is those ground rents and debt being alternative sources of funding. You'll have to either pick one or the other. And obviously the ground rents are very, very long-term structures. So I think if you are going to go down the ground rent route, it's certainly a viable option of raising capital, but you need to think about whether you're prepared to accept the long-term consequences of doing that. I think the other thing that is to be aware of, one of the trends we see on the deals that have been done over the last 12, 18 months, a lot of the lenders are asking for collateral to support the interest. Inevitably, as hotels have been shut, lenders have been saying they want either cash collateral or bank guarantee or something similar to make sure that if the hotel isn't trading, the interest cover is there. It will be interesting how long that takes for that to run off. I guess lenders will look at the trading the hotels, and eventually we'll see that fall away as a requirement. But be aware, if you are coming to a lender for financing, that is something you need to think about, is how you're going to demonstrate that you've got the capital to support the interest payments until trading reaches its maturity. So I rather bravely give my prediction on ground rent was spectacularly wrong. I sort of tried to have some thoughts as to what I think is going to happen over the next 12 to 18 months. So I think the reality is that we will see the debt funds, the alternative lenders coming into the hotel space more and more. I'm aware of a big insurer who's got the ability now to lend on hotel deals, and that's relatively new in the last 12 months. The proliferation of debt funds has been immense. And similarly, I've spoken to a number of people who are now looking at setting up or have set up mezz funds lending in the hotel space. So we will see ongoing growth in the number of lenders who are lending into our sector. I also think debt funds, and Aaron, you can come to this on the panel, their pricing will come down a bit, I think. I mean, clearly, inevitably, the debt funds pricing is more expensive than banks. You'd expect that. But we are starting to see one or two debt fund deals where the pricing has come in and been surprisingly competitive. They're not at debt, bank levels, but I can see with a number of debt funds, we can see some competitive pressure starting to come in there to get deals away. I think we will see banks coming back to the market. I know a number of them are trying to get deals away, and I think we will start to see, as the market returns, as we see hotels start to open up trade again, we'll start seeing more and more lenders return to the market once they've sorted out the overcapitalization, refinancing of their existing deals. I think for development finance, it will remain tricky. I think we've talked about the rising costs. The construction industry has been hit by some spectacular increasing costs for things like steel, labour shortages. There are some real challenges facing the construction industry going forward. And I think that's going to make doing development finance incredibly, incredibly hard to get away. And I think it will be a number of years. If you look at the history of the last 20 years, it's always been that development finance deals have come back to the market pretty much at the end, normally so that they open just in the middle of a recession. But so I think the development finance will continue to be very tricky. That's probably good for existing owners, because that means there won't be lots of new supply. So overall, that's probably good for rates. We talked about this number of things, and what are the big challenges, I think, facing lenders? I think we can sort of look at this in a number of ways. There are some massive macroeconomic issues that we are facing. Everyone's looked at the inflation numbers of touching 4%. Interest rates are at an all-time historic low of 0.1. You can take your own view. I'm not an economist, but I think there must be a feeling that interest rates rise. If you go back to what I was saying earlier about margins having gone up by 75 to 100 basis points, part of that was offset by the government or the Bank of England cutting the base rate. Once that starts to unwind, and let's be honest, interest rates can't really get down from where they are, those rates are going to go up, and the margin, we'll see how quickly those margin increases come down. Interesting, there's some evidence from the real estate finance sector that pricing has started to come in, particularly for the prime assets. So I'm aware of some central London offices that have been financed on incredibly competitive rates. I think for those prime assets in central office on brilliant lets, we are seeing a lot of competition for that kind of financing, and the margins have unquestionably come back to where they were in 2019 for the prime. I don't think it's happened yet in hotels. I don't know how quickly it will happen in hotels, or indeed if it will happen. But clearly, if we're talking about a 75 to 100 basis point spread increase on margin and interest rates start to rise, then yes, we've talked about increasing costs of labour and all those sort of things in costs of goods. I think the increase in cost of debt is going to be probably an even more significant figure. If you look at the debt on a number of hotels, you start putting 150, 200 basis points on their debt package. That is a very, very significant drain on their cash flow. And I think that's as big a challenge as the others. I think, touching what Graham said, clearly when you're looking at all those competing issues, the rising cost of labour, the rising cost of debt, that is going to make meeting your financial covenants very hard. And we've had 2 years where most lenders have not, and most borrowers have not had to meet their financial covenants. That is going to change. Financial covenants are going to come back. And I think the challenge for lenders and owners is, where are those going to get set and how tight are they going to be? Given the challenge that's coming up, I think it may be very tough for owners to meet those covenants and lenders to set them at a level. There's a genuine test as to whether the debt works, but also achievable. So I'm going to touch very quickly on what I think we'll see on insolvency. As Graham said, we haven't really seen many formal insolvencies. Some of you be aware, in the press there was a fairly high profile real estate insolvency, which I think is beginning to show that some of the lenders are starting now to look at their deals, and if they are over geared and they think there is no prospect of that being fixed, I think we will start to see some formal insolvencies. I think, however, what we will see as a trend is, I think the lenders will be very reluctant, certainly the banks will be very reluctant to be seen to be pulling the trigger on deals. And I think we'll see a lot more what I would call soft enforcement, so very significant pressure on borrowers to refinance, to sell assets, to raise more capital. I think that's what we will see. Instead of banks sort of threatening insolvency processes, we'll see lenders really trying to encourage their borrowers to re-gear or de-gear in a particular way, or sell assets, or to somehow get a refinance through. And I think we will see that sort of thing starting to happen. And we've seen assets come onto the market that we know are coming onto the market for exactly that reason, because lenders are trying to get the owners to de-gear their position. And I think we'll see a lot more of that, because I think inevitably some of those over-geared positions, there is no other exit other than a sale or some sort of equity raise. So what factors do I think are going to drive lenders to come to those decisions? I think leverage is going to be a critical one. I think market values are going to be a critical one. And we've talked about interest rates. The other thing we haven't talked about is currency. So the value has held up partly because of the sheer weight of capital going in. Where's that capital coming from? Well, the answer's all over the place, but a lot of it's coming out. America, the Far East. Why? Because sterling is so cheap. I'm not an economist, so I don't know when sterling is going to correct that, if it's going to correct that. I hope before next year, before I go on holiday. But the reality is, once that does start to correct, if it does start to correct, then some of that foreign capital, the reason they've come to the UK is because of the exchange rate risk. They view it as a safe bet because sterling has been so cheap. So we may start to see some of that capital fall away if they take the view of the exchange rate uplift that they're getting by buying UK situated assets is not there. And again, we've seen with some of those Far Eastern investors that, you know, they select jurisdiction by jurisdiction, partly on where they think is the best assets, but partly on where they think they can get bang for their buck on exchange rates. So again, some of the Far Easterns have dropped out of the US market because the exchange rate moved against them. So again, I think that will be a factor for us to keep an eye on, is where exchange rate. Again, the other factor I think will be perception of market value. I've talked about it. What is going to happen? What is our industry going to look like? Who is going to stay in hotels, and where and why? And I think for everybody, your view on what that is will drive what you want to lend on, own, invest in. Who knows what the right answer is? Probably we'll have one of these in 2 years' time and find out the answer. I think the type of lender will drive it. I think we'll see the domestic banks will be incredibly soft. I think the international banks will possibly be a little bit more aggressive. And if you look at the recent sort of insolvency, that was an international bank. Debt funds, it will be a massive variation because they will have different investors, different risks. And I think also the last thing will be refinance risk. I think we will all look at the market and say, well, for the existing debts, one of the key issues is going to be who is going to refinance my loan in 3 years' time. Hard to predict. And as I said, the positive news, I think, is we have seen so many new lenders coming into the market. I think that is a very positive thing. But clearly, I think all of those factors, if you're an owner, you should probably run that analysis yourself and go, okay, if I'm talking to my lender, I need to have thought of all of those things. so that when I go and have that conversation, I can demonstrate that my loan is a credible, viable loan that is worth the lender continuing to lend on. So thank you very much. I think Graham and I are going to take any questions if there are any, and we will spin back to the opening slide. Thank you.
Thanks very much. It's right, I've got glasses on to read the questions. We've got a few minutes for questions from the audience as well. Has anyone got questions for Graham and James? So for those two great sessions, so thank you. First one, so the first question here: are banks really questioning the sponsor business plans? The third question. This is split into different parts, so let's start with that one first. I think it's on.
Just make sure, yeah, you can hear that. Great. I think if the question's around, are banks really challenging business plans or simply accepting the first thing that's handed to them?
The next part of it is, are they realistic as well? Right.
Well, I think, look, I think the good thing about the hotel industry is that actually a lot of the lending institutions that are involved have been involved for, a long time. They understand the space with individuals that have been close to the sector for some time. So, we do see that. We do see the challenge. We do see the questions being put on what look like over-optimistic plans to make sure that the work may well be an equity plan, but there absolutely needs to be a bank case. And people need to understand whether the covenants and the recovery profile works under that bank case and not just the optimistic equity case. So, yeah, we absolutely do see that challenge.
I think I'd add to that. I suspect, again, lenders and more tenants, I suspect it's probably never been harder to get a hotel deal through credit than it is today. So if the answer is there challenge and rigor around those business plans, I'm sure the answer is yes, it's very, very thorough. And convincing your credit team that this is a deal worth backing, I think is probably as tough as it has ever been.
I mean, it is, because it ties into what you were both saying earlier, wasn't it? Because actually all the forecasts have gone out the window. Can I ask, what surprised you particularly? What have you learned during this period? Particularly, anything? Because it has everything. I mean, changes constantly, doesn't it? I mean, that's what's so fascinating about this period of time.
I think it's the fact that having been old enough to get through a couple of recessions now, they broadly went as you'd expected. COVID has, I think, as both of us have said, it has changed the market in a way that none of us expected. Nobody thought that there would be no aeroplanes in the sky, no one would leave the UK. For some people, they haven't left the country in 2 years. So now I'm on a business trip for 2 years, 3 years, something like that. It's inconceivable. Had you said that to me 2 years ago, I think I would have thought that's absolutely absurd. I think also the other thing, and I said this at the start, the lenders really have performed in an incredible way to get the industry to where they are. Yes, of course, there are pressures now, but I think it goes to show that actually when the chips are really down, the lenders genuinely are on the side of the borrowers and genuinely want it to be a success. It was, you compare it to the great financial crisis where, without going through lenders, the lenders all took different approaches to defaulting borrowers. Here, there was a genuine desire to get their customers through to the end of it and to do everything they humanly could. And as I said, some of the lenders I work with were working incredibly hard, really sort of getting up at 7, finishing at 10 o'clock at night every day, to get those cases through credit, to get the C-bills away, to get those deals in place. And I think, again, as an industry, everybody pulled together to get that done.
I think the thing for me was around actually something, if you talk to a lender, quite often one of the things they say is that we really care who the borrower is. And, I never really gave much credence to that. So, well, the hotel's the hotel, and, whether the shareholder's X or shareholder's Y, as long as the hotel's performing, you've got good managers in there, that's all that really matters. Well, actually, as we hit this particular crisis, knowing who the borrower was, knowing that the borrower had access to capital to plug some of those gaps when trading simply stopped. I think that was more important in this particular crisis than it's ever been. So I think that was it really kind of brought it home to me as to why that question is asked as part of that credit process compared to just the hotel itself.
the gentleman goes on to ask, and it's a fair one because we haven't really touched on it that much, is how do you think products offerings will change and service delivery change? Any thoughts on that?
Is that for hotels or for debt?
Well, that's a good question. Let's do for hotels, shall we? Because that's going to be quite a key piece in this whole discussion, isn't it, as we go forward?
Well, I think one of the trends we saw pre-crisis was really the rise of this limited service, extended stay model. And, I don't think there's any doubt as we look at all the cost pressures that are coming in, where are they coming in? It's really through labour. It's really through supply chain. So, that ability to have a much lower cost base around F&B and with labour, in that extended stay, limited service model, I think it's only probably accelerated, the appetite for people to roll those products out and invest in those. But I think we've also seen actually at the top end, then when those businesses can reopen, then that luxury demand, the wealthy demand is actually quite resilient, and their ability to absorb the price increases to offset that cost pressure is also, that's not a bad place to be. That real struggle is that middle band, where are you really able to increase your rates sufficiently to continue to provide that full service when those cost pressures are growing at the rate that they are.
It's going to be interesting. James?
Yeah, I mean, if you look at the two key drivers, particularly in London, the major cities, you've got business travel, you've got tourism. The challenge is going to be how we price a product to make that, how much those markets come back. And let's be honest, air travel, I suspect, is going to go up. Again, don't know, but talking to our aviation guys, you look at what's happened in that industry, it's been catastrophic. The end result's likely to be airfares will go up eventually as a long-term position. So it is going to be more expensive for people to travel on holiday. So what's going to happen to those tourism? Is there a cheaper hotel option? If it's going to cost them more to get here, is there a cheaper proposition that works for them to stay when they're here? And similarly for business travel, it's so hard to predict what it's going to look like for when people do come back to travel. Will they be going away for longer term, shorter term? I agree. I think the service departments type, the sort of long stay, will work. Maybe whether it's long stay or not, though, I don't know. I think it may be that product works, but on a much shorter stay basis. Whether that works from a cost perspective is, I guess, for others to comment. But yeah, I think the market will be driven by those two key factors and how those two markets come back.
No, I agree. Can we please say thank you to our speakers, Graham and James? Thank you. Now I please introduce Russell Kett, Chairman of HVS in London, to come to the stage.
Thank you, James. Good morning, ladies and gentlemen. And may I please invite our distinguished panelists to join me on the stage. Louise Gillon, Bank Leumi, Tim Helliwell of Barclays Bank, Aaron Taggart from Shaney Capital, Peter Anscombe from Edwardian Hotels, and Jan Willem Turlo from the Westmont Group. And thank you, if I may add my note of thanks to Graham and James for their presentations and for setting the scene so effectively this morning. I was noting in your presentation, Graham, that you showed a spike in July 21, and you attributed it to the growth in staycations, and mentioning particularly Bournemouth. I hadn't realised that my own staycation to Bournemouth in July 21 had such a major effect on the statistics. But if James can be spending £300 a night on his hotel in Cornwall, then I think the hotel industry is certainly doing well by at least some of the people in the room. And I'm relieved that we are again back in person. And that we didn't have to watch online as Graham's pussycat walked in front of him on the screen and disrupted whatever proceedings there were. But ladies and gentlemen, we're here to answer questions. And the 5 very well-informed experts who've joined me here on the stage are going to answer your questions, both from home or office, if you're online, and from you, ladies and gentlemen, in the room. And please use the Q&A function if you're online. And with a bit of luck, I'll be able to read what's in front of me and take those questions. Those of you in the room, this is an interactive session. Does everybody know the meaning of the word interactive? I'll repeat. Does everybody know the meaning of the word interactive?
Yes.
Wonderful. So just raise your hand if you have a question, and we'll get a microphone to you and so forth. For the avoidance of doubt, we will be issuing a recording of the session today, along with the copies of the slides. And my thanks to Lauren Bush, someone whose name you probably don't know, from our Partners EP Business in Hospitality, for so ably taking care of the technical aspects, particularly for those who are watching online, along with Karen Freeb and the team at Bird & Bird for hosting us today and for all their technical prowess as well. So it's enough of a time waster from me. Let's get on to the subject in hand. You've all got microphones. Please use them when you're speaking. And I'm going to start with what each of our panelists considers to be the single most pressing issue affecting the hotel sector today, which you see as an impediment to the pace of recovery. So just one to start with. And you know, I am a chauvinist at heart. So Louise, please kick us off.
Staffing. Staffing.
Oh, staffing. Okay. Do you want to expand on that, or is it just staffing generally?
I think it's staffing in general.
Okay.
The increased cost, the lack of workers available. Hotels now are, free to open and trade, but can only do so at limited capacity in some instances because they just don't have the staff available.
Okay, so you've taken staffing. All four of you have to think of something else. Aaron.
I'm going to say the challenge around financial forecasting. It's really, really tricky, especially if you do have London hotels, extrapolating from the points that were made earlier. The different sectors or different segments are coming back at different times and different paces. So that's the biggest challenge that we see is, especially if you have London hotels in your portfolio, is the pace of that change. Will it come back? When will it come back? How will it come back? And I think that's one of the questions from the audience was around that. Are we interrogating business plans? And we are like never before, because you look at an income line and now you're drilling down into, well, where is all of this business coming from? Talk me through your segmentation. So what I would say is that, again, taking forward what James said earlier about how well the lending market has reacted to what's gone on as of late, I would say that from my perspective, that's definitely, from a sponsor perspective, they've definitely stepped up to the plate as far as we're concerned. The quality of the information you get, how well they know their businesses, how well they're articulating the challenges and how they're reacting has been really fantastic to see. So I would say as a sector, we've all put our shoulder to the wheel.
Okay, Peter.
I think to a certain extent, but when we're talking about things to do with the projections or whatever, the comment was made earlier relative to prior recessions, past situations industry's been through. I think the situation this time round is that we're really looking at something where it's got nothing to do with economics. There isn't a past precedent that you can really look to. And the opening up of the market is purely reliant on the removal of restrictions from government and some corporate restrictions that exist. So it's the inability to actually know what you're projecting for, how the industry can actually recover. There is strong signs in terms of people's ability or willingness to come back. But in terms of when will the international markets come back in? What will be allowed relative to events, etc.? How will properties be able to operate? It's the unknown, which has got nothing to do with any prior downturn. It's purely down to what the restrictions will allow. And that's what governs the market. And no one knows what decisions they'll make, so you can't predict anything.
So uncertainty continues. Jan Willem, you've got a very positive outlook on life, haven't you?
Yeah, I think the problem really is all around the travel restrictions, as Peter was saying. I think, and the lack of airlift. particularly in the international destinations, if you look at London, Paris, Amsterdam, which are heavily inbound, both business and leisure, and the lack of trade fairs is the other one. There is not a lot of trade fairs and very little MICE business around. So I think those things are really a big worry for me.
Okay, and last but not least, Tim Helliwell.
Well, I don't think anyone's specifically mentioned the word uncertainty apart from yourself, Russell. So I was going to say uncertainty.
Okay, I won't mention it.
And I think there's a bit of a mixed message, really, because yes, uncertainty, and certainly we are seeing clients, concerned as we go into Q4. MICE has been mentioned, business travel, and indeed going into Q1 in terms of what the winter's truly going to hold, and that's causing a lot of clients to think very carefully about their modelling. Having said that, there's also a lot of confidence out there as well. And certain clients are feeling, in fact, majority of clients are feeling remarkably confident. So there's a mixed message here as well.
Okay, I'm looking at the audience here as well as online. In case you have a question at this point to put to our distinguished panel, gentlemen here, please announce who you are if you're prepared to go public.
I am
making a
never shy. So my name is Michael Kenny from Deutsche Pfandbrief Bank. Someone's got to ask the question at some stage. We've got all these other uncertainties in the market about travel and so on, but we've all become incredibly aware in the last 18 months about the environment, social and governance aspects. I'd like to hear the views of the panel as to which bits of that they're more concerned about, and if any of that, which they're positive about.
Thank you. ESG, not a subject I suspect that all of you are going to be keen to speak on, but looking at Aaron and Tim nodding their heads vociferously, if you could nod your head vociferously, that is. Let's start with Aaron.
Okay. I actually am more concerned about that part than lifting of restrictions, if I'm honest, because I think lifting of restrictions is something that absolutely will happen at some point. I think the issue we have is that COVID has forced us all at the same time to undergo the experiment of, does the technology work? And the technology works. And then the consequence of the technology working is, if you throw ESG into that, I can say as a fund that has institutional investors, we are being pressed incredibly hard on ESG. Incredibly hard. From 3 years ago, where it may have been 2 paragraphs in an investment committee paper, it's now, right, you better know your ESG stuff. Otherwise, we are going to interrogate you at investment committee. And so there's two levels of ESG that I'd like to touch upon. The first one is actually the challenges that we're going to have then around. So my issue is not lifting of restrictions. My challenge, or one of the big challenges that I see, is, does that corporate travel come back? Yeah, and I think the answer is it does, but not like it was. So I think that's going to be a big challenge for the industry, because ESG is going to say, really, you're going to be traveling that much? That is not consistent with your ESG philosophy. So I think that's a bigger challenge for the industry. In regards to actually how does ESG affect values, that's a whole different subject altogether. And I think that is coming down the pipe very, very soon, in terms of being demonstrable, your ESG credentials, the effect it has on the bottom line, in terms of top line revenue, whether people vote with their feet and say, well, if you don't have a great ESG policy or outlook, I'm not going to come to your hotel.
I have to say, from my own experience, Darren, we're finding that there are investors out there who won't look at a particular investment unless they have already gone through the hurdles. They're not going to retrofit an ESG policy and accept an investment without them already being there. Tim, from your perspective?
Well, there's a number of perspectives. One, consumers pay for ESG. And, we put some research out last week. Gen Zs, they'll pay a 35% premium on sustainable food and beverage. And If you start looking then around what that means to top line, because it's of a lesser of an impact the older you get, but fundamentally that's where the demand source is coming from. So people pay for ESG. Secondly, Aaron touched on it. If you don't do ESG, the concept of a brown discount is also starting to emerge as well. So, and there's work starting to emerge around the costs of not being sustainable. So, it's and then from us as an institution, it's probably you as the same. We've committed to being carbon neutral by 2050. I mean, we as an institution, we're carbon neutral already, but what we're actually saying is that we won't lend to you unless you are carbon neutral, which is a completely different commitment. Clearly far more relevant in power, energy, etc., but still huge relevance to this sector. Just the only other anecdotal bit I can give you, and I apologise, but we were involved in it. We did co-led the Whitbread Green Bond earlier this year for what is a COVID impacted sector. It was still 10 times oversubscribed. So it just goes to show the demand on the financing side as well.
Okay, I'm going to go back to my agenda and then come on to a question from our distinguished online audience. A question mainly for the non-bankers on the panel, so that's the middle three. How have you as borrowers sought to address this key issue? How understanding have your banks been so far? Has it been in line with what Graham and James were telling us? But how do you expect this to evolve in the coming months? Do you expect a change in the attitude? What do you think might be driving this? So, Jan Willem, let me start with you.
Well, I think we reached out very early on to the different lenders which we had on our different portfolios and single assets, and work with them through the crisis and trying to find a kind of a long-term solution. We're relatively lowly leveraged, so that's a good thing. But generally, it's just working with the lenders through the whole period, and now everything is reopening. So again, it's going to be a bit of a long-term relationship.
Okay. Peter, you're involved in a new opening. How has that been affected as we've gone through the last 18 months, and your attitude to the people who you formerly called colleagues?
If one's looking purely, if we look specifically first relative to new opening, how's it been affected? I mean, it was certainly delayed. From 2 points of view, delayed relative to obvious delays on construction work linked to various restrictions in the market and what we were able to do. And then the aspect of trying to find the right point in the market to open it, given the nature of that property and the form of sort of free market that it needs to operate properly. As it stands at the moment, that one is probably hitting no more than about 30% occupancy and about 13 midweek, as it's very early in its days. If you look across the estate in terms of those that are open for normal market operation, then you're looking at 50 to 60%. And last weekend, most of the hotels were at 100%. So the new hotel was impacted, coming back to the previous question in terms of, yes, policies of sustainability on the F&B side, local suppliers. You mentioned Green Bond. I mean, the Londoner Hotel was the first BREEAM Excellent hotel. It was the first green loan put on a hotel. That does exist within the publicity for that property. It is getting, last night, the restaurant, a hotel restaurant on a Monday night being essentially full. It's fairly unusual, but it was last night. I can say there are certainly people in there tonight paying $7,500 for a room. There are people willing to pay money. The room rates that we're getting across the estate, etc., not not too bad at all. I'm not sure whether I'm off the point of the question now.
I think you probably are, but we won't put that to the vote. Aaron, was there anything else you wanted to add on this particular question? How kind have the banks been, and what's been your own experience?
Yeah, I don't think anything different. That's not what has already been said. Yeah.
We don't need to be in violent agreement with each other. So let me turn to the bankers. So what funding from your own shop, respectively, is really out there? How important is it for borrowers to resize their loan covenants to reflect the current day business plans? And how would you recommend that they go about this? What's a realistic loan to value? We heard, I think it was James, forgive me if it wasn't, I think James was talking about LTVs, particularly in light of the mezzanines, in light of the non-bank financing that's out there. What would you start to feel uncomfortable with when you're looking at a loan to value? And is the development of hotels still a no-no? So not a very long question at all for you to answer. If you can remember the beginning of it, Louise, why don't you start there?
Okay, so we've been very active in financing hotels throughout the pandemic. Primarily, we've been looking at financing new acquisitions. And obviously, this is much easier to structure than the existing refinancing that's out there. In general, we're comfortable at about 60% LTV, but we have carved out of that 2 years worth of interest costs and operational loss reserves where necessary for, as we've said, central London hotels, where we know that they're going to be operating at a loss for a period of time. So what that takes you down to is quite a conservative cash out the door figure, probably 55% LTV, to be honest. And I think this is the conservative structure that we're in. Now, financing new acquisitions, that's achievable because obviously the sponsors are bringing equity to the table on day one. Refinancing at these levels requires equity to support to the table, which simply isn't there. And that is more challenging. So at the outset, we reached out very much to mezzanine lenders to see if we could work together to have some framework in place, knowing that the refinancing market is going to be challenging. And that's what I project we will start to see next year as things are refinancing. It will be done as a non-standard structure where equity will have to either come to the table or find a way of bringing somebody else to the table. I don't see that we will be back to financing back up at 65% LTV ratios until the level of uncertainty is dropped.
Okay. Tim, from Barclays or your own personal perspective.
I think the V question is quite difficult because I don't think, it's a difficult question all around. In terms of our activity, we saw, February, March time, kind of an inflection where we seem to move away from our side, at least, the managing of the pandemic, and we're started to be able to be more outward looking. And I think the reasons for that were around the budget, the government measures, but also, of course, the success of the vaccine program as well. So we felt that February, March was a kind of an inflection point, and certainly, since then we've been actively looking at new business, whilst frankly still being very much involved with the existing portfolio. I think the only thing I would say, just to place some context around, you talked about all this government support, and what does it actually mean? We did, and just to put some context on it, we've got roughly, let's just say, 20% market share here in the UK. We did 28 billion of government-backed funding, and we did it between April and September last year. And half of that was in the government-backed bond market. So if you then said it was 14 billion of more corporate style and SME debt, we did over 10.5 billion of bounce back loans. So that's 335,000 bounce back loans, and we did over 2.5 billion of CBILS, which was about 1,200 loans, and we did just under 1 billion of CL bills, which was about 130 odd clients. So there's a lot of that. And if you think about that 14 billion, we've got 20% of the market. So then you can think about what that tracks across. So there is a lot of leverage out there, and there is still quite a lot of work that needs to be done, to the point that James and Graham have mentioned. There's still a lot of leverage. And a lot of this does come back then to the point around there has to be some form of, we're now at the stage where leverage is not the solution. And to be frank, many clients are not looking for leverage as the solution. And it's therefore some form of pref equity structure or something where there's a deferred equity share. Ultimately, I think that's where we're going to. But equally, to the points that Graham and James made before, everything is now just on a complete case by case basis, because there's so much variable out there that you can't generalize.
Before I move off the bankers, do any of the other three members of the panel have anything to add to that particular question?
I think from our side, the way the market's looking at the moment, you can get that mezzi prefy type money to, I think operators and actually probably the investors and lenders are looking at it almost like a bridge.
Okay.
Sort of like bridge capital. It's bridging to
Short
more
term.
normalized times. And so it tends, if you'll take a 2-year view as an operator and say, if I've got to carry heavier cost of capital, I don't really want to give my equity away if I can live with a fixed cost of capital and I can get it. 2 years, carry a heavier cost, hopefully come out the other side.
Yeah, some of us can remember back to the early 90s where the word equity became a 0% quite quickly. Sorry to digress, but Peter or Jan Willem?
I think the one thing on the refis, obviously some of these deals going to need some equity investment from the sponsors. And the one thing not to forget, a lot of people were refinancing. The debt is much more expensive versus the previous debt that was on the asset. So that's the point that was being made earlier. Quite a big impact for the owners.
Understood. Okay, let's turn to our non-bankers just for a minute. From a borrower's or an operator's perspective, how much operational risk do you consider there to be now compared with what we were used to before, and how challenging is it when you're looking at forecasts and to be confident about what you're putting in front of a lender or an investor and so forth? I'm not asking you to put careers on the line, but is it really that difficult? Are you not confident of being able to present an adequately comfortable projection looking ahead? How about you, Peter? You've probably most recently having done that.
I suppose we're as comfortable as we can be in the projections that we're given, or that we are giving. The projection now is far more dynamic than it used to be, because you're constantly changing based on other information that's coming on. The booking windows tend to be so short that it's that much harder to get to grips with the trends within that.
So previously you went ahead with a forecast, and whatever bank you were talking about then took a knife to that and said, well, I don't believe that, and I'm going to reduce that. Are you automatically presenting an upside and a potential downside to everything that you're presenting?
Certainly, as we went through the last period and the refinancings that we would, or restructurings that we were doing, on that we did provide downside cases as well. So we'd have sort of 2 or 3 scenarios within that, because effectively we're looking to the mid case, I suppose. It's hard to be overly optimistic, but we have a more conservative case, and then it's what if it is that much.
Okay, Jan Willem, any differences?
No, I think the one thing, obviously, the projections for this and next year are obviously quite difficult, and we're in the middle of the budget process at the moment. And I think there are obviously some big challenges also on the average room rate, which we haven't really addressed so far, particularly in the city centres, which are significantly down because of the lack of demand. So that's obviously still a recovery, and we know from the past, Russell, that takes a long time for the average room rate to recover. So that's something I'm quite worried about.
You say that, I'm sorry to challenge you say that, but I've heard at least twice this morning people saying that average room rates are holding up well for the business that you're currently getting. I'm not saying that it isn't the case, and I've always said it sort of lags behind occupancy, but I'm quite encouraged by what I've been hearing from certain hoteliers who've said that their average room rates are holding up pretty well.
I think the hotels where we had very strong average room rate growth actually particularly this summer, was in Sardinia, and we had some hotels in St. Jean Cap Ferrat between Nice and Monaco. So those were had very, very, very strong summer. We have some hotels in Tuscany, and obviously the regional UK hotels did pretty well as well, holding up right. I think London, Paris, and Milan and Amsterdam again are and they have, particularly in the mid-market, it's big challenges on the outskirts.
Yeah, I think mid-market has already been mentioned already this morning as being a particular concern. I was very impressed with a luxury hotel in London. One of my clients were telling me just how they have gone out and got different business in, and it happens to be at a higher room rate than they would have expected. So anyway, Aaron, anything to add?
Only getting back to the question about forecasting, the swings are so huge. Yeah, in terms of the levers being pulled here, opening up country to immigrate, to tourism again, corporate travel coming back online. I think the conference market will come back, in my view, quicker than people think. It's certainly in terms of there's been such a lack of conferences for big companies that at some point they're going to have to do a reset conference or this is where we're going and this is how we're going to get to it conference. So the levers just are so wide. We're just not used to that. We're used to incremental or the bookends being much narrower. They're much wider than we've been used to. And I think that's where the big challenge is.
It sort of reminds me of the opening of a new hotel compared with next year's budget. Tim, you wanted to add something?
Yeah, just an anecdotal point that when we worked with all of our clients through, Q2 last year, looked at all of the forecasts that we received, not a single one, and this is from a quoted international group right the way through, not a single one considered that there could be a further lockdown. They're all focused on a speed of recovery. And I think that's also a challenge in terms of how we have to look at forecasting these days, is that there can still be not quite the same black swan event, but nonetheless something that can be very fundamental to the trading of.
So my assumption is that you are both pricing in a higher level of operational risk than you would have been doing previously.
Yeah.
Same with you, Louise?
Yeah, we're asking for a bit more information than we would have previously. We're very interested in each asset's break-even position, what level of trade they need to be at to break even, and to be able to quantify the cost of being closed. So I don't think the risk of COVID has fallen away. I think all of the financials that were provided to us, I don't think anybody traded in line with their projections, but actually they've traded the August period much more positively than they projected. So it's difficult.
Okay.
I think it's a sort of two-way thing, because if we look back at the beginning, very few banks were willing to accept that there was a possibility that it would last more than 6 months. So the whole aspect in terms of what we were trying to cover, and if you look at it in terms of closed down properties, and particularly large central London properties, the amount of millions that you're burning per month, and you need to find a way of sorting it. And yet at that point, banks weren't willing to look at more long-term, what we say, restructuring within the facilities or conditions within the facilities, because their credit people would only make decisions based on what was known.
Yeah.
And therefore you have to wait for the problem to get worse in order to get to the next stage.
Okay.
I think on a lot of the sort of restructuring side, it's mentioned relative things like the CL bills and banks' appetites, and there is no doubt that the banking market has been very supportive. Some more so than others. Most banks have looked very much towards their own individual structures. So again, if you're a company that's got a range of bilaterals, it's a question of how it all fits together. You put that together with the CL bill structure, that with the LBO structure has a different identification of group companies and the way money is allowed to pass between it. And you end up in a situation where you can't move money up, down, or across the group. Then you get into the point that you have to actually identify what is it that's causing the problem to your business, and you need to get out of that facility and into another. That's basically what we ended up doing on one of our facilities to get rid of the problem, to bring a 9-figure sum of liquidity back into the business. There are other lenders out there. Then it's a question of picking the right one that can be a partner going forward, because as soon as, whilst we did it closed market, not open market, the amount of cold approaches I had of people who wanted to lend us money was ridiculous. So it's there, but it's finding the right people, but it's also a question of identifying what is the root cause causing you problem of really controlling the business.
Okay, I'm going to move off where we are for a time to address a question which one of our distinguished online audience is asking. She's saying, are franchise or management agreements with global brand hotel companies still reassuring or encouraging for bank or lender financing? What's your view, Louise? Is a brand important, or will you do something with any old hotelier?
I wouldn't say any old hotelier.
Or any young hotelier, as far as I'm concerned.
I think the branding is location driven. There are some locations where a brand does add value, but there are others where actually it's just a necessary cost. I think at the moment, flexibility is very important, and perhaps brands can be slightly more restrictive than if you're a boutique operator, able to think outside the box and generate, revenue from new business activities, which a brand may restrict you from being part of. So I don't think it gives us a significant level of comfort that the brand's there. It's still who's the management behind it, what are they doing, and what their business plan is.
Okay, people.
Agnostic, but we're obviously aware of the trend from independent to brand, and it's a trend that's been going on for over 15 years. Just in general, I'd say that we felt that the owner-operator franchise model was a more flexible one in working through and managing the challenges over the course of the last 18 months or so. But that's not to say there's not very strong benefits from a management contract in a certain location for a certain proposition of hotel.
Jan Willem, you and your company straddle everything from franchise to management company to independent to probably other things that I can't even think of. But what's your view on how this particular sector of the market has evolved?
I think it's all really location driven and asset driven for us. I mean, there's been a lot of change in the business, and we've branded a lot of our products in the past, mainly with franchise. We have a very limited number of management contracts. But particularly in the city center and the international locations at the airports, branding is a big beneficiary for the hotel operation. But some of the hotels can also run on their own as an independent boutique hotel, so that will work really well as well. So we're totally agnostic in terms of the branding. We'll do the best for the.
And Aaron, from your perspective, how important is a brand, whether by franchise or by franchise and management? How important is that to achieving a successful deal for you?
I think for us, it's less important than it was. I think in terms of where you get your business from, and the channels now is much wider than it was 20 years ago, let's be honest. So I think it's less important. And yeah, look, I'm just going to echo what everyone else says. It's really absolutely individual in terms of location, in terms of product that you have. I can't really add any more than that. Sorry.
Okay.
I think the one thing to take into consideration, I think on the franchise model particularly, is the control of the cost. I think this is on the positive side. I think COVID gave us an opportunity to look at the total cost basis, and we have been able to take some costs out of the business on a permanent basis. So we've eliminated some transportation at some of the airports. We've changed some of the food and beverage offerings. We closed down some of the swimming pools which were guarded. So there is definitely some permanent cost savings.
And where the brand has been involved, have they relaxed brand standards permanently as well to enable those costs to be stripped away completely?
No, I think during COVID, yes, for sure. But obviously now we're recovering. I think there is a lot of demand from the brands to bring the brand standards back up to where it was before.
Okay. Change of tack. Will some hotel models become redundant or obsolescent? Is a 400-room conference hotel in a B or a C location fit for the knacker's yard? That's my words, not the gentleman who's put this up on the question. What do you think, Aaron?
Right. The thing that we love about the sector is the transparency, the amount of research you can get, numbers, the deep dive that you can make into the sector. And what I think the way this will play out over the next 5 years is the market will right size. And it's very, very good at doing that. Yeah. So there is a lack of development at the moment, as James alluded to in his presentation. I don't think that's necessarily because there's a lack of debt available to do it. I just think that everyone's pausing on development and saying, okay, well, I can think of a couple of one asset very close to this office that is going to be repurposed from a hotel to probably student. And so there's a lot of that reassessment going on, and the market will right size. So in terms of course, there will be some attrition. There always is in every single sector of real estate, there'll be attrition. Yeah. My prediction is the one I made earlier, that I think that actually getting corporates and companies together is going to become even more important. Yeah, even more important to get them all in a room and set everyone on the same direction, because you're not all going to be in the office at the same time anymore.
So you weren't referring to the Savoy Hotel, were you?
I wasn't. No, definitely not.
I just wanted to reassure people in the room and at home that the Savoy will still be there. Peter or Jan Willem, do you feel that maybe some of your hotels are under threat because the MICE business in particular, in a sizable quantity, isn't going to return? Are you going to have to repurpose those hotels?
Certainly not at this point. I think we would regard virtually all of our properties in terms of being in a prime location. I know you specifically said B or C locations. There's only one that's really outside London in terms of Manchester, and that one actually over the last while has been one of the top performers. It is about the top performer in Manchester, so as long as we can keep it in that position. From a general side, because of the nature of partnerships and relationships we have within the industry and with the various suppliers, bookers, whatever, because whilst we are a brand entity on one side, we are a fully integrated entity that has a whole load of direct partnerships with the major entities to bring our own business in. So the level of interest on the meetings and event side is definitely building. The new hotel that's only been open a matter of 3 weeks or so has run several 350 to 450 people, dinners, events, awards. There is a reasonable amount of business coming through. I suppose if you said which one would I therefore be worried about, the meetings and events side of the Heathrow property would definitely be under threat going forward, depending on how that part of the market comes back.
Okay.
Russell, I mean, the one thing is, even after the great financial crisis, even the poor quality hotels and poor located hotels, most of these hotels are still around today. I mean, how many have been bulldozed? I mean, and they're still, none of them were fit for purpose before the great financial crisis, and they're still here today. So I don't know. I don't expect there's going to be a lot of conversions.
Okay. We've run out of time, and I'm guilty for the first time of overrunning, such as the excitement of being in a room full of people. So last question, ladies and gentlemen, very quickly, and literally restrict your answer to one sentence, which means you don't have to take a breath. So what single piece of advice, given everything that we've talked about, given everything that we know, given all the presentations that have gone before and all the discussion that we've had, one single piece of advice do you have for a hotel to enable it to reset its balance sheet effectively in order that it is fit for eventual recovery. And I qualify this and say, doesn't have to be one size fits all, doesn't have to be every hotel that you're embracing in your answer. But Louise, you're going to be last. Tim, you're going to be first, and work along the line with the microphone.
Thank you. Communicate with all your financial stakeholders, to quote Graham.
Okay, Jan Willem.
Yeah, communicate particularly with the lenders and with your lessors as well, because we haven't really talked too much about that.
Peter?
I think the biggest one over the next while will be the question of relooking at covenants, and it's a question of how much the banks will understand that the covenants need to be set towards looking at a forward projection of what the industry looks like, whereas historically it's always been about protecting the level of credit standing of the business plan that they originally had. It's what price they will seek to put on the fact that they now have to change it to reality.
Okay, one breath, please, Aaron.
This is easy for me. I would get yourself a really good corporate advisor, because the debt market and the equity market and the MES market is incredibly nuanced. You're not going to know all of that capital that's out there. Get yourself a good advisor.
Okay, Louise, half a breath.
I would say be clear as to what your core business is and find a strategy to protecting your core business, and be realistic about what you can achieve over the next 3 to 5 years.
Okay, ladies and gentlemen, please join me in thanking our panelists.
Well, we have a double brief rack from Chris and I today. Paul, we thank you all for coming. We challenged each other to come up with 3 very brief takeaways from today, having heard all these amazing insights from our industry experts. And for me, I think the first thing was clearly the prominence of ESG and the premium for companies who espouse sustainability, and the prospect of the dreaded brown discount. Thank you, Tim, for those who do not. Secondly, for me, the challenge of finding staff and that the impact that will have on the hospitality sector and on service delivery. I mean, those of you who've tried to book a place at a decent restaurant in London recently will find that you often have to wait weeks, if not months already for that. And thirdly, for me, London. What is going to happen to London? We've heard about the fact that London hotels are suffering when compared to the UK regions. Chris made the point that we're projecting a 60% density of people in London compared to the density pre-lockdown. And I thought, is this the ideal platform for the levelling up that we've been hearing so much about over the last couple of weeks, both from the Labour Party conference and Andy Burnham in particular, who wants the transport systems in Manchester and London to be equalised, and also ad nauseam probably at the Tory party conference this week. So is London going to see a bit of a decline? Is this an opportunity for the rest of the UK?
I think it's a very fascinating point, isn't it? Just quickly, before we start first hybrid event, and just let you know, we've been joined by 260 people online as well, which I think is fascinating how these events will develop, just for some context. Some great panelists, I thought, today. I love that comment about confidence against uncertainty, and it's something we've all got to live with, isn't it? And I think that's the really weird thing, isn't it? I think people are getting more confident, and yet we've never been less clarity I've ever known in my life. So it is fascinating. You can't predict what's going to happen in January, let alone December. It's going to be strange. I also thought the 35% about Gen Zs prepared to pay 35% more is a fascinating piece, because actually I was having that conversation with a number of Gen Zs recently, trying to get my head around about how they will pay more for a food brand over nutritional food, and how this is all going to change dynamics in so many different ways and delivering products. I think the whole market and how models are impacted is going to be fascinating as we go forward. City centres, absolutely are going to face real challenges, I think, as we come back. That 60% density, the room rates piece, I think city centres are going to change in ways we probably haven't even thought about. And I think that's going to be a really exciting journey. And that's my 3 points, isn't it? I've got number 2 here, but I'll keep to 3 and play fair. So look, absolutely loved today. It's been fascinating. Thank you to everybody.
Thanks again. And thanks for everyone in particular who's attended in person, but also thanks to everyone who has dialed in online. And thanks again to our distinguished speakers and panelists. So if we could all show our appreciation to finish up. Thank you.
Finally, very quickly, thanks to Bird and Bird for hosting today.
Thank you.